On February 13th, the centre agreed to the Supreme Court's suggestion of setting up an expert committee to strengthen the regulatory regime for Indian markets. The purpose of this panel will be to ensure that market investors are protected. The development comes after a critical report by US-based short seller Hindenburg Research led to a massive slide in the stock prices of Adani Group companies. The group's stocks fell 50% in the aftermath of the report. In a matter of days, it lost over 9 trillion rupees in market capitalization. At the same time, SEBI's submission to the apex court said that the markets regulator was inquiring into the allegations made by Hindenburg against the Adani Group and its impact on the markets. Released at the end of January, the Hindenburg report accused the Adani Group of stock manipulation and improper use of offshore tax havens. The group has denied any wrongdoing. Appearing for the Union government, Solicitor General Tushar Mehta told the apex court that the government believes that the existing regime, regulators and agencies were fully competent to deal with such situations. Despite that, Mehta added, the centre would not oppose the court's suggestion of an expert committee for strengthening the existing regime. For the proposed committee, the government has agreed to share the names of domain experts with the apex court in a sealed envelope. Earlier, the Supreme Court had sought a response from the centre and SEBI by February 13th on the steps needed to improve regulatory and statutory mechanisms to ring-fence investors against the kind of volatility seen in Adani Group shares. On February 14th, Adani Enterprises reported a consolidated profit of 820 crore rupees for the third quarter of the current financial year. This was an improvement from a loss of almost 12 crore rupees a year ago. While the group grapples with the fallout of the Hindenburg report, the allegations against it have also raised apprehensions that confidence in the broader Indian markets could take a hit. Against this backdrop, what can the proposed expert committee do to improve investor protection?
The crux of the Hindenburg allegation is the issue of round tripping. Many of the FPIs, that is the foreign portfolio investors, the ultimate beneficial owners of these FPIs may not be known. And this is an age-old problem. So from that perspective, I think much more needs to be done from a regulatory scrutiny of the FPIs, from a KYC perspective, know your customer and the ultimate beneficial individual owner of these FPIs, to whether they are funds for any Indian entities or businessmen or politicians or bureaucrats or others. So these are issues which are not easily answerable, but definitely much more efforts need to be put.
You ask anybody who has been closely associated with the markets, they have sometime or the other come across or invested in a stock which was being manipulated. If one does a preliminary check on the valuation vis-a-vis the other stocks in the same sector or checks the steep movement in the said stock without much of a justification, one can fairly conclude that they are being manipulated. I feel this expert committee should have their ears to the ground, should have analysts onboarded who could study the suspects and confirm whether further investigation is needed or not. Where there are allegations of round tripping, and that too across geographies which include tax havens, the job of the regulators get that much tougher. They may also need to involve other investigating agencies, and reaching a conclusion in such cases also becomes difficult and could take long.
There are also some steps that the panel could take to address Hindenburg's conduct and to reduce the potential for similar events in the future.
Any derivative instruments which is created outside the regulated market, I think in some form these particular instruments are injurious to the overall health of the market and the economy in general. Given the situation in which I think the swap instrument has been created by using the P-note route by the research house who has shorted the bonds of Adani groups, this is something which is quite unpredictable per se on one side, and at the same time I think it's quite detrimental to the very health of financial markets on the other side. So the recommendation here would be that if at all any investor or a trader who wants to create an instrument, it has to be operated onto the platform, market platform in India where the stocks are listed and under the regulatory environment. I think the panel should suggest that I think any instruments operating outside the country, that too in a non-transparent manner, this cannot be treated as a regular instruments or legal instruments. I think this should be, definitely taken up very seriously with the counterpart regulators in the other part of the world.
Their first remit or the first question that expert panel will have to examine, that in India you have got all the laws which control short position, short selling, and there is a risk management mechanism which is online mechanism, and I can put it on record that Indian exchange risk management mechanism is the best in the world. So they are saying that while you have mechanism to control short selling here, but there is no mechanism to control a short selling through the structured derivative products which happens outside Indian regulatory regime. So there are two challenges. One is first how to know that any short position is being created. The second, if it is being created, how you can bring it to Indian regulatory regime.
Apart from allegations made against Adani, are there any other parts of the Hindenburg report that need to be addressed? For example, the report says that India's economy has been held back by the broken state of its capital markets.
To paint the market with the same brush and to state that it's a broken state of capital markets is absolutely a figment of their imagination. We have one of the robust systems in place for the exchanges. Even a major market crash in 2020 saw our exchanges working smoothly. Corporate governance standards of our listed entities have improved tremendously in the past few years. And we have been consistently been rated high by global bodies of banking and capital market regulators. So I don't think we need any certificate on this from Hindenburg.
Overall, experts are confident of the Indian regulatory regime's fitness. However, with the increasing popularity of India as an investment destination and the growing stature of its companies, it may be time to not only improve the framework but also update it to manage risks emanating from foreign shores.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.